So this is the CBOE Skew Index, so Chicago Board of Options Exchange. And let's talk about first what it measures. So like anything, there's different ways to interpret it, but for me, it's a measure of potential market risk. So kind of like the VIX index. Okay, so it can kind of serve as a measure of investor or trader sentiment, but also market volatility. So it's calculated using S&P 500 options, essentially looking at tail risk. And standard deviation moves from a mean over the course of the next 30 days. So then what's the difference between the VIX and the skew index? So the VIX is based on implied volatility for at the money strike prices. Okay. Those are option strikes closest to the price of the underlying VIX. Skew is based more on implied volatility of out of the money strikes. Okay, that's important because when there's hedging occurring in markets, so if you think about your institution, your large hedge funds, but institutional money where there's large positioning, and that's usually going to be bullish positioning. Okay, that will often be hedged in some way, and that typically will be with out of the money put options. Now, because of the demand for hedges, like all markets, right? Options are based and priced on supply and demand. So when that demand increases, there's a greater demand for hedges or put protection, right? They become more expensive. And often that hedging will take place because of the expense, and you'll typically see that where if you look at an option chain of the SPX, right, you'll see relative to call options, put options will be relatively more expensive at equidistant strikes from the current underlying price of the S&P. So because of that, you'll see hedging taking place at further out of the money strikes to reduce that cost of that hedge. Okay, so key here is skew is going to more measure the difference in the skewness, right? The difference in the out of the money call and put premium. Okay, so what does that all mean? So the higher the skew level, generally the higher the perceived tail risk or risk in the market. The higher the concern that something like a black swan event will cause a major market sell-off. So when we correlate this to levels, price levels on the skew index, it's below what we see here on the chart, but the 100 level is a good kind of barometer where if you get a skew print at 100, okay, the kind of perceived distribution of S&P 500 returns is considered to be normal. And by that measure, okay, in terms of probability, there's a smaller chance of an outlier. So, in other words, less of a perceived tail risk or black swan event. So essentially, skew can help us kind of gauge perceived market risk. Well, that's important because that perceived risk is not generally going to be tied to, a retail trader. This is going to give us a good indicator of institutional market risk perception. So I won't go into all the, in great detail, the calculation of it, but just to give you kind of a frame of reference, a 5-point move in the skew index adds or subtracts, so whether it's a 5-point move up or down, around 1/3% to the chance, or maybe we want to just say to the risk of a 2 standard deviation move. So if you ever wonder why we use the Bollinger Bands, right, with a 2 standard deviation setting, okay, there's the correlation. So going back to the level, the price level of the skew, again, it's not a tradable asset, but for frame of reference, if skew's at 100, okay, the market is telling us, right, that it's expecting volatility to remain normal. Okay, so as the skew index rises, let's say it's up at 150. I mean, we've seen this year some very high skew prints up above 180. This suggests that there's a significant or large number of traders expecting significant volatility in the S&P 500. But it means something else that is probably more applicable to how we want to use it for trading decisions. So a high skew index is telling us that institutional traders, so portfolio managers, hedge funds, are hedging their portfolios against unexpected volatility returns. Whereas a low skew index suggests that portfolio managers have a more modest expectation of volatility. All right. So now I am going to place a chart of the VIX side by side with chart of the skew index. And we'll kind of take a look at the correlation. So they're not perfectly correlated. But what tends to happen is, okay, if we look at And so where this becomes valuable is the skew print will often give us a good leading indicator of volatility in the VIX. So it's an inverse correlation. So when the skew index is high, okay, so this is back in like January, February. If we go back to January, February here, right, we're seeing low VIX prints. Okay, so this is what you would expect, not amongst the retail trading crowd, but amongst professional portfolio managers, hedge funds, the so-called smart money. So they will use this to determine the most appropriate time to hedge portfolios. So when the skew index is high, okay, and the VIX is low, okay, and I'm actually going to zoom in here so it's a little easier to see. And I'll just pick out an example. So if we go back here, okay, so we'll just use the obvious big spike in April. Okay, so here we have a skew up around 150. Okay, and that was starting around March 25th. Okay, so if we go to that time period over on the VIX chart, okay, what do we see? We see, while skew is high, the VIX is low. In fact, it was bottoming on the 25th when the skew index was peaking. And then as skew begins to come down, what's the VIX doing? It's spiking. But what you'll notice is that the peak or high skew print here indicated as a leading indicator ahead of time before volatility increased. In other words, before the VIX spiked, that there was a greater likelihood of that and more perceived market risks. So hedges are getting put on as the skew index is rising. Why? Because there's demand for put protection. And as that demand is fulfilled and there's significant out of the money put buying occurring amongst portfolio managers, hedge fund managers, so on and so forth, okay, the skew index rises. And that's the inverse correlation. So when you see, but here's where it kind of becomes a little bit more complex. So when skew, I use this as a contrarian kind of indicator. So when skew is low, so notice how as the VIX spikes here in the beginning of April, what's the skew index doing? It's coming back down because the so-called smart money had already put their hedges on. The demand for the put protection is drying up. So the differential between out of the money call and put premium starts to even out. Skew comes down, VIX spikes. Okay. And then the VIX comes back down and skew starts to rise again. Okay, so where it becomes a little more maybe challenging or not quite as straightforward is we're not really necessarily dealing with a bounded oscillator here where there's well-defined limits or extremes. So you have to kind of look at this on a relative basis. This could everything that happened here can happen at much higher skew levels. So you don't get too caught up in the actual price level of the skew, although that, like, as I mentioned earlier, there's some relevance to that. Pay more attention to the trend or direction of the skew print.